What is up, everybody, and welcome to Money Legos, a podcast about global economic freedom and the builders making it a reality. I'm Greg Brainerd, and I'm excited to bring you this conversation with Christian Widhalm. Christian is the CEO of Bloom Credit, a platform that lets customers access consumer credit data via API. Bloom Credit is backed by Allegis Capital, Commerce Ventures, and a number of other prominent investors. Previously, Christian was the Chief Revenue Officer of LendKey, one of the largest consumer lending platforms in the U.S. Christian, welcome to the show.
Thank you for having me. I'm happy to be here.
Yeah, well, we're super excited for this conversation. To start us off, I wanted to ask about Bloom Credit's inception. And I'll attempt to frame the situation and let me know if I have anything wrong. So you're at LendKey, and your colleague, Matt Harris, says he has an idea to transform the way credit bureau data is accessed. What were you thinking at the time? Were you tempted to jump ship and join him? How involved were you in those early days? And I'll pause there and feel free to bite off any of that you see fit.
Yeah, sure. So background is that Matt Harris was a colleague of mine at LendKey previously. And I want to say sometime in middle to late 2016, approached me and said, hey, I got this idea to help consumers improve their credit score, right? And better understand how they can improve it, because I think there's a gap in terms of the understanding of what you need to do to improve your credit score. Especially at that time, a lot of consumers weren't as empowered as they are today with credit scores on hand, and it was a really interesting idea to come and help the consumers directly. So my wife happened to be 7 months pregnant at the time with our first kid, and it was not a conducive sort of time period for me to kind of be jumping ship to take on the endeavor with Matt. But I love Matt. He is incredibly smart, incredibly talented, is a great mind for credit and credit data and product strategy and everything else. So I have a lot of faith in him. But I decided, I told him that I'm not going to join, but I will come on as an advisor and help you actually get this, get it off the ground so you can actually, start progressing the business forward. So, early days meeting and kind of going over models and kind of, hey, what's the direction look like? Who are the types of customers we want to go after? Should it be B2C or should it be B2B2C? And then I helped him with some of the early kind of pitch stuff when he was really kind of getting ready to take off. And then I kind of backed away probably shortly after, probably late 2016, and just acted as an advisor when he needed me. Ultimately, when Matt was on the journey for that particular iteration of the business, he found a lot of difficulties working with the major credit bureaus in order to get data. And for good reason. The bureaus have highly regulated information. It's very sensitive, and they put a lot of guardrails in front of being able to access it. So the time period to go, by the time you actually go and reach out to the first person, go through all the use cases, figure out if it makes sense, go through contracting and commercials, do integrations, get through all the compliance and diligence, it's like 12 to 18 months before you're actually really pulling credit data by the time you first wanted to start going and doing it. So after a bit, he realized that there was a big opportunity to help power, the next generation of financial services companies by enabling them with better infrastructure in accessing and reporting credit data. So the business pivoted, I believe, in 2019, and ultimately he started getting traction with the pivot and raised a Series A. A little after he raised the Series A, he just decided that he didn't want to be CEO of the business anymore, but still wanted to be involved and stay on the board, and decided to look for a successor. And he reached out to me and said, hey, you kind of know high level about this pivot, and I want to kind of give you an overview and see if you're interested in coming on board. And so he gave me a little bit more of a detailed overview of exactly what was going on with the pivot. And my eyes lit up immediately, because this was a problem that I had dealt with firsthand, in past lives, where accessing credit data was difficult. And not only difficult with doing an initial integration, but once you do an initial integration, how are you actually building it in? Are you hard coding things? Are you doing stuff that's going to not allow you to, in the future, use other credit bureaus or take in the data? The data is all slightly different. There's nomenclature that's different. The integrations are different. The way you're doing it's complicated. And that was definitely a component. And the other is the furnishment or the reporting. A lot of people don't know what furnishing of credit data means. It really means reporting of credit data. So taking consumer payment information and sending it to the bureaus. The bureaus are only good if they're getting data to store in their repositories to update on the consumers, and that is a very important piece to be able to send the data back to them. And so what we do at Bloom is precisely that, which is modernizing the credit data infrastructure through a single API that's bidirectional between the credit bureaus and our clients, that allows our clients to do simple integration into Bloom, but then have access to the data if they want to use it for the purposes of underwriting, extending credit, showing a consumer their credit score, in a single integration where the formatting comes back and called a Bloom format, right? Where everything's the same. So if they wanted to switch bureaus, if they wanted to make sure they're taking things, they're not parsing all this XML or other types of data to do it. We simplify everything for them in order to do that. The other side is furnishing or reporting on the bidirectional front. And that is a really old, well, it's 26 years old now, standard that the bureaus basically have agreed to take their data in from, called Metro 2. And Metro 2 is 300 or 400 pages of documents in this thing, or in this document called the CRRG, which basically is the reporting guide for how you're supposed to report data to the bureaus. There's all these different things and nuances to it, and it's very tough to go and take on yourself. So for us, we've built these rails and continue to refine them, that basically allows for that bi-directional passing of data between the bureaus and our clients. And we focused on making the APIs and the integrations very, very modern and simple, where we're really kind of focused on making the lives easier of the developers and product people that are tasked with bringing these products to market in a much, much faster time period. So for bringing someone to market for accessing credit data, we can do it in under 6 weeks, and that includes the Sprint integration on our client side. And then for furnishing and reporting data, it's a little bit longer. It's about 8 weeks in order to go through the proper channels to get everyone approved to report that data. So big focus on the developer for us, and also a big focus on shepherding our clients, through that kind of credit bureau diligence and compliance and credentialing process.
Yeah. 12 to 18 months to integrate consumer credit bureau data, before Bloom is a pretty astounding fact, right? I mean, you think we live in modern times and data is kind of easily accessible, but it just goes to show you that there's so much opportunity for solutions like Bloom Credit to come in and modernize. So I do want to get into some of the modern day issues with credit reporting data and some of the stuff that you're doing at Bloom Credit to rectify those issues. Maybe just briefly before we do that, how did you handle the transition into CEO of Bloom Credit, and what did those conversations look like with the board, the investors, the customers, and I think you handled the transition really gracefully, and Bloom Credit's kind of off to the races. And so for others who maybe haven't seen those transitions go down, or haven't done them themselves, how does one attack that and keep everyone comfortable and excited about the direction of the company?
Yeah, it's a great question, and one that I actually get quite a lot, because not being the original founder, to kind of come in and be CEO at this stage of a company, it has its challenges, right? Obviously, from a board perspective, and an investor perspective, everyone continues to have a lot of faith in Matt. Matt's a great mind in the space, but for me coming in and having those conversations with everyone and kind of instilling the confidence of my background and understanding that I was basically a client effectively of this. I would be a client, today, was obviously important. And obviously the team has a lot to do with that too. So it's not just the board and the investors. It goes beyond that to the team that you're getting. So, the team was very gracious in me coming in, very receptive to some of the things that I was doing to come in and not change course by any means, but refactor maybe some things that we were doing where thought there was going to be more kind of strategic value for us to focus on in the near and the midterm, and they were great with that, and so was the board and the investors. It is, like I said, it's a challenge, right? It's when you come in and you're not the original founder, there's stuff that you take on that you didn't get the luxury of doing when you were the original founder, and that takes time, right? I've been here about 18 months. I joined in July of 2021, but everyone has been incredible to work with. Matt was really great with the transition, and obviously that can be problematic for in certain instances, but ultimately we had a smooth transition, very supportive from him, continues to be supportive, as well as the rest of the board. So it was, it can be daunting. I would say that the experience that I've had was probably better than most.
And it probably doesn't hurt that you were so involved in the early days, an advisor, right? And it could be thought of as sort of a homecoming of sorts. And I think
Correct.
I read somewhere that you even helped name the company. Is that true? Did you come up with Bloom, or is that?
It is true. It was in one of those nights where I met Matt on a Friday somewhere in the city in a WeWork, and we were kind of going over the modeling and doing everything and thinking about some stuff, and names came up, which you don't really focus on names that much during that time, But I threw out Bloom Credit for I'm like, these people, their credit's blooming. If we want their credit to bloom right now, it's like they're whatever. And I'm like, let's just call it Bloom Credit. And it was all right. That's a working name. Let's call it, and it stuck. So, yeah, it was the original. It definitely a little bit of a homecoming, given the fact that I had, a lot of involvement in the very early days of the business.
Yeah. Well, the name is descriptive, and it's a solid one, if I may say.
Well, thank you.
So, what are some of the biggest problems with credit reporting data today? And before we pressed record, you were mentioning some of the case studies that you guys have done at Bloom Credit, just in unearthing kind of what's going on and some of the issues that exist today. So if you could, give us kind of the lay of the land, that would be super helpful.
Yeah, this is a very interesting topic and one that we're very close to. So I can probably talk too long on this, so you can cut me off and redirect
We've got time.
When I'm getting off course. The net of it's this, right, is that we have a credit reporting issue and problem here in the United States where there is a significant amount of errors that are on the credit reports of consumers. There was, I believe, a consumer report study that was done in 2021 that basically found that like 34% of consumers have an error on their credit report, which is incredibly high. Now, some of those are more benign, like the misspelling of a name, by a letter, or you're off by one number in your social security number, and something was just off, whether it was user error or whatever. So, but still a very large percentage. The estimate is that 5% of consumers have an error on their credit report that is actually negatively impacting their ability to get credit, either outright, where they're not going to be approved, or where they're going to be approved, but at a rate that's going to be higher than what their actual credit risk is because of the error. And the lenders are looking at, how that error shows up. If you look at the bureaus, they're all fairly the same in terms of the number of accounts that they actually have. Accounts being records, individual unique consumers in the U.S. I think TU says they have like 236 million consumers. If you look at that and you take 5% of those 236 million consumers, that's about 12 million total people that have a issue on their credit report that is negatively impacting their ability to get credit, which can be material, right? The case study that we were putting together was kind of taking some of these and putting real illustrative examples that are reasonable to see what that impact would be in call it undue interest on the consumers. And over a 6-year period, we did that specifically because we were looking at like what loans do people normally take out. You can take out a personal unsecured loan. The average personal unsecured loan is about $10,000. At weighted average life of that loan is about 1.5 years or so. These are close-ish numbers, about 1.5 year weighted average life. And then, if you have that error on a personal unsecured loan, the spread of rates is much greater. let's say it's a 3% delta. You were supposed to get a 10% loan, but you got a 13% loan because of what was on your credit report. Over that year and a half of weighted average life, the consumers, the 12 million consumers, are spending over $5 billion in undue interest for that personal unsecured loan. If you look at an auto loan, about an average of about 25,000. It's probably gone up a little bit, probably closer to 30. Let's just say 25,000, and you were mispriced by 1.5%. So you're supposed to get a 6% loan, you get a 7.5% loan. That number is about $11 billion on a 2.5-year weighted average life. And then a mortgage has about a 6-year weighted average life, which is why we're looking at this over a 6-year window. Average mortgage in the United States is about $225,000. I think we put $200,000 as the average loan amount for the purposes of our examples. And if you were mispriced by 75 basis points, you would be impacted on that $200,000 loan for those 12 million consumers by over $100 billion. So collectively, it's about $120 to $125 billion in undue interest that consumers are actually paying in loans in those examples, which are fairly reasonable examples for people to get one personal loan, one auto loan, and one mortgage over a 6-year period. So if you look at that on a daily basis, it's $56 million a day on average. Obviously, the averages are not averages. The real numbers are kind of not even because of the way amortization schedules work and the way the interest comes down. But on average, over that 6-year period, it's around 55 to $56 million in terms of undue interest that consumers are paying on a daily basis in the United States. So that's one side of things, right? Is that there's errors that are occurring in that are negatively impacting consumers. There's also a whole nother set of folks. There's 100 million U.S. consumers that are deemed underserved, right? I think this study was Deloitte or McKinsey. It was one of the consulting firms that come up with that. And that really kind of means that either people have thin or no credit file, or they're subprime or just underbanked, which is obviously a significant amount of people in the United States. And a lot of those folks are trying to find ways that they can build credit. Now, credit is a very interesting thing because you can't build credit unless you have credit, right? You can't sit there and just magically have a 750 FICO if you've never had a loan before. And a lot of companies and a lot of consumers are looking for credit builder products, especially in this environment, to help them actually build their credit. The building of credit is very critical, and a lot of them start with things like either small personal loans or secured credit cards and the like. In many cases, those folks are also relying on the typical payment cycles or statement cycles before things get reported to the bureaus. So that average statement cycle is 30 days. People want to be able to actually see their trade line show up faster, but they also want to be able to see their payments show up faster rather than 30 days. They want to see what's happening. I made a payment yesterday, or I cleared an account yesterday, it's still showing, or last week, I have to wait 30 days before that's reflected. So there's a couple things that we have done, and what we really focus on the furnishment/reporting side to help fix this problem. One is the accuracy of the data. First and foremost, everyone wants better accuracy, right? It's better for the bureaus, the major credit bureaus, because the accuracy of their data, integrity of their data is everything. So they're always focused on ways to fix this problem. The lenders want to make sure that they're making the decisions on the most appropriate data that's available to them when assessing credit risk and assigning price. And then obviously for the consumer, who's directly impacted by paying more in interest rates over time. So everyone's pretty much aligned to fix that. And the problem is a lot of data that gets into the system does not go through a series of logical validations. And so what we've done is that we make it very simple. One, we make it very simple for our clients to integrate. So they integrate, they pass us the data, and they can pass it to us in real time as things happen. An account gets opened, a payment gets made, it goes into our system. We take that data, and then we transform it into Metro 2 in the standards, so they don't have to do it. They're just sending us their normal data. But we then go this extra step before we send it to the bureaus. We take that transformed data and we run a series of logical validations to make sure that the data makes sense. and that there's no inaccuracies that are being reported. And we find about 1.25%, 1.25% of records that we're taking in have issues that we then flag and we send back to our clients for remediation, right? And that is a huge kind of number. If you're thinking 5% total of consumers in the United States have an error that is material enough to impact their credit negatively, we're finding about 1.25% of accounts before we submit them that have issues that we then send back for that remediation to fix.
Yeah,
so
that is fascinating, and I think it's one of the most interesting things about Bloom Credit is that it's not just the read data, it's not just the pull request from the bureaus, it's the write data, right, WRITE in terms of reporting,
and the right and the RIGHT
and the RIGHT, the right data back to the credit bureaus, which is so impactful, and probably how this issue can start to be solved, right? Of consumers having accurate credit data, accurate reports in order to get the right loans and have the lenders be able to underwrite them properly.
100%. And you look at the other side of that, accuracy is massive. We want to make sure that people aren't getting hurt. And an example of that, I'll just give you a random one. Maybe a bunch of account records came over from a client that said, I don't want to say a bunch. It could be one, it could be 1,000, or whatever the number would be. But an account record comes back over and it says that this particular consumer is being flagged as 60 days delinquent. And our validation might look at the account open date, and the account open date was 30 days ago. That's obviously illogical, right? Nonsensical. That can't happen. So we have the luxury of having all of the past payment history that our clients have reported to us, and we go through the sequencing of, does everything make sense in the validations? And then if it does, it gets passed on so that we can get ready to load into the bureaus. And if it doesn't, it goes back to the client again for that remediation. And obviously, this has been a huge point for the CFPB as well, with the bureaus and with others, is why is there illogical data that's going in there? It should be able to be actually flagged, found, and corrected. And we've made it a huge point to make sure this gets fixed. Like, we're a B2B credit data infrastructure company, but our kind of mission about what we want to do is actually more consumer focused. Our mission is to expand access to affordable credit, right? And we think that the best way to do that is to make sure that the tools are in place so that folks that are lending and providing that credit have the best possible data they're making decisions on, and can then send the repayment data in as quickly and accurately as possible. Now, quickly is the other side of this. So I'd mentioned before, accuracy paramount, right? You want to make sure that anything gets reported is accurate. But then you have this other thing for speed. And we have near real-time furnishment. Our clients can send us data basically at all times. We can take that data and then package it up and basically send it to the bureaus if we want to, like in under half an hour. So it's the amount of speed in terms of doing that versus going and doing the traditional 30-day statement cycle is it's a pretty big deal. And it's big for a couple of reasons. One, talking with different folks at the bureaus and in the industry, people will dispute that one number I said from Consumer Reports about 34% of consumers having errors on their credit report. A lot of folks think that a lot of those consumers actually have made payments and are not seeing payments or accounts actually reflected quickly, and it's actually leading those consumers to flag them as disputes or flag them as inaccuracies or dispute the data, where the consumers under FCRA have the ability to dispute any information that's on their credit report. So by doing real time or in near real time, you can take the payment data, you can perform the validations, you can send it over to the bureaus, so that now, instead of actually having consumers not being able to see things reflected, they could actually see things reflected much more quickly, even like the next day, by data coming in, being cleaned, sent to the bureaus, and then being able to see it reflected on their credit report. So that's a major component to actually saving the consumer a headache of not understanding what's going on and why it's not being updated, but also the bureaus and the lenders who have to actually maintain and have hard and soft costs, right? For managing the disputes process, resources, and there's other costs for regulatory. I call it regulatory capital, right? Being in the crosshairs of certain regulators who want them to make sure that they're actually fixing these problems. So it is of a big concern for them there. The other thing is on types of loans that get reported. So I mentioned before a credit builder product. So a credit builder loan, and for the financial service company that's offering it to the consumers, they want to be able to demonstrate that they actually can start building credit immediately. They don't have to wait 30 days of a normal cycle before this thing's going to get actually posted and put on there. They want to show them that within a day or two, the bureaus would have taken that data and now actually showed it to them in their credit report, and that it is being reported. So the speed for credit builder products is big. The other thing that's big is for more smaller dollar loans, and like a very good example of this is BNPL, the buy now pay laters, and that's specifically because a lot of the BNPLs have these pay in 4, pay in 6 sort of models. Those are very short term. You're talking about 1 to 2 months in terms of total time that they're actually making payments on these loans. So waiting for a normal 30-day statement cycle doesn't make sense there. The other thing is that the BNPLs, as well as the CFPB and others, do not want consumers to be what's called stacking loans, right? So if things aren't being reported or not being reported quickly, or heaven forbid not being reported at all, which is a lot of the stuff in the BNPL world right now, consumers had the ability to go to every BNPL and start taking out more debt. The only things that the BNPLs would actually be able to see were past transactions or past loans taken out from them with that consumer. They wouldn't be able to see anything else unless they were pulling the updated credit data. So real-time reporting.
That's crazy. Sorry to cut you off,
Yeah.
but so you could go to any website and then take out a loan with one BNPL provider, say Affirm, and then go to another website, take out a different loan with a different provider, and then stack those loans on top of each other. All of a sudden you have thousands and thousands of dollars of debt, and no one knows that, right? And so that's not hitting any sort of credit reporting, et cetera.
Nope. And it's of risk to everybody, right? It's of risk to the BNPLs who don't know what they don't know about the consumers taking out all these other loans. The CFPB, they don't want people to actually overextend themselves and take out more debt than they need to or what they can afford. So that's not good there. It's not good for other lenders who don't see that reflected on the credit report and are making credit decisions on maybe another loan and don't know that they've got all this other debt that they've taken out and either don't have that much more room in their wallet to take on another loan, or they're just outright not paying something, right? And I'm blind to that risk as a lender. So that becomes problematic. And this isn't the first time this has happened, right? I think back when marketplace lenders, online lenders, their name changed over time, came on board, like the lending clubs of the world, the Prospers, the Upgrades, the SoFis. Everyone started having kind of the same updated kind of a customer like UI experience where you did not have to have a hard pull done, a hard pull of credit, hard credit inquiry. They started shifting more towards soft inquiries, which weren't really that big, weren't that popular until they started becoming more popular about 10 years ago, where it's, hey, come and check your rate. It doesn't hurt your credit. And ultimately what happened is that you'd have the exact same instances of loan stacking where someone would go to each of those. They take out a $30,000 loan for each of them, but they basically do them all at once, whether the same day, same browser session, whatever. And they would then do the soft pull. Then they just sign their loan agreements and hit submit for the hard inquiry for the final approval, on all of them immediately. And instead of getting one $30,000 loan, they got 5 $30,000 loans, right? And obviously not good for the lenders, having people come out and do that. That's more of fraud and scam stuff. But those lenders started trying to figure out a way that they could have a repository of soft pulls, so they know if people are hitting soft pulls more and things like that. So that was tried to be solved in that use case back in, call it 10 years ago when this first started becoming more of a problem. But now for BNPL, it's a whole nother challenge, right? History always repeats itself. It just repeats itself faster now, right? So now you got the BNPLs that have come in, and they're experiencing the same thing, either not reporting at all, not reporting quickly enough, and no one actually going and seeing what's going on. So the ability for the near real-time reporting is also huge there, as it gives everybody some protection, including the consumer from themselves.
Yeah.
So we think like the days of the 30-day statement cycle, 30-day pay, of reporting, it should, we think it's dead for us because we're focused on things much bigger and faster. We think it should be dead for everybody.
Mm-hmm. Yeah, more real time kind of data availability, and
Yep.
and these are really interesting use cases where that availability of the data in a more real time fashion is paramount to the success of the consumer, the lender, the bureau, et cetera. So we're in like a market environment of rising interest rates, probably lower origination volumes, maybe defaults are on the rise in some categories of loans. I know we all sort of play being macroeconomists, and so I don't want to put you too much on the spot in that regard, but how do those types of things affect Bloom Credit, and are they detractors, or are they almost beneficial in that they make the problems more apparent that Bloom Credit is going to solve? So hopefully that's a fair question. I'll pause there and feel free to tackle it.
Yeah, no, it's a great question, and one that I get asked a lot. And the interesting thing about credit data is that if it's sunny outside, you use credit data for one thing. If it's rainy and cloudy outside, you use credit data for another thing. So it has multiple sort of tools and usage. And I think that's important. And honestly, I think it's more important in the cloudy and the rainy days, and the time kind of where we're going at from a macroeconomic perspective. So during the sunny days, I'll stop saying weather related metaphors.
It's a useful metaphor.
Yeah, but during better times and growth in the economy, there's a lot more. There's more money that's going out. People are more loose on lending. People are ramping up originations. Money is cheaper, obviously. Like if you look, especially if you're a lender, especially if you're a fintech lender, your cost of capital significantly goes up if you have to tap into the capital markets. So the amount of capital that's available and the price of the capital is much better and good times for you to be able to tap into that and then put loans out. Also, raising more money and focusing on things like customer acquisition costs. You'll be doing that and growing the business. And credit data then is predominantly used for originations, right? I'm originating loans. I want to keep moving the ball forward. In more times of economic uncertainty, kind of like where we're at now, it's a whole different side of the business. One is, and one we'll talk about furnishment, right? So furnishing or reporting of credit data is huge because it's the carrot and the stick, right? The proverbial carrot and stick. So the carrot being, hey, I'm gonna give you this loan, whether it's a credit builder loan or just a regular loan, and you already have established credit, and your credit will improve, and you'll be able to grow your credit and everything else, and you get the proceeds from the loan, blah blah blah. Great. But you also have the stick, right? And the stick is you need to pay this, otherwise it's going to be reported to the bureaus. In the instance that someone doesn't pay, it gives them more of a push that they could could negatively impact their credit if they actually don't pay. So furnishment is a key sort of obviously component there, and we have a lot of people that have approached us, like banks that have approached us that have been purchasing assets, consumer assets and whatnot, and sometimes they're purchasing assets where the loans are not being furnished, and for some consumers they're having problems getting them to call them back because there's no stick. So they've reached out to us about ways that we can help them actually furnish that data and get it on the trade lines for recovery faster. The other side is on the actual credit data. And there's two main use cases for credit data in this environment when you're not using it for originations. Originations are still happening, right? But it's just not at the same level or scale. There's something that we call account review. So if you are a lender and you had a relationship with somebody, with a consumer, and they're on your portfolio and a serviced loan, there's a strong chance that something within their creditworthiness or their history has changed. Let's say that you've had them for a year, 6 months, 12 months, 18 months. The account review allows us to provide clients with an updated snapshot of their borrowers, right? So I know that if my weighted average FICO at time of origination was 740, right? I may now 6 months later, 12 months later, want to repull it and it's 680, depending on who you are. If you're a regulated, depository, or if you're somebody else, you might want to start thinking about your loan loss reserves or how you're actually thinking about planning for that, right? The whole kind of CECL stuff, whatever. So there's a whole kind of component that's over there. But you also want to start finding out some of the people that haven't gone bad yet, but might be going bad soon and might need some help. And you want to make sure that you're top of wallet when you're getting paid. So if you look at somebody that was a 740 and now they're a 620, and you look at the time of origination, the utilization rate on their credit cards was 10% or 20%, and they had a $10,000 credit limit. Now all of a sudden they have a $20,000 credit limit and they're at a 90% utilization rate, meaning that they took out more debt and they're using it more because they're becoming impaired, right? Or potentially becoming impaired. So if you are a lender, it gives you the ability to start to take a look and be like, how do I want to manage my existing portfolio in a time of uncertainty, make sure that I'm actually curbing losses and boosting my returns. And a very good way to do that is by doing an ongoing, at least quarterly, update on your data to make sure that you can actually see what's good and what's going potentially bad. So that's one. The other side,
that portfolio monitoring, and that's really something that these lenders can access through Bloom Credit. Is that right?
Yeah, correct. Yeah. We have that bi-directional, right? We furnish, we're pulling data for them, and that's usually it's much cheaper than what you pay at origination. The stuff for extension of credit for that permissible purpose and that price point is more expensive. So if you have a bunch of existing clients and you want to be able to pull, it's at a more reasonable rate since you've already had these folks in your books. So yeah, we have the ability to go and do that directly through our API. Everyone gets it the same format. So if you took origination data credit data at the time of origination through Bloom Credit, you're going to get it in that Bloom format. This is also going to be in the Bloom format, so you can just
you don't have to refactor your whole data ingestion processes.
Correct. And then on the other use case that's very popular right now is what we call the direct consumer or the B2B2C model. And that is, you have people that now they've slowed down originations, but they also want to make sure they're still providing value to their customers, especially now, and they want to be able to show them their credit score. Right, so that is the consumer authorizing this entity to show them their credit score. So clients do the same thing with us. They've coded in, they have that same Bloom format. We send them the data, and they have the ability to then show on screen the credit score, and they can show reports or the whole report and trade lines. They can show them trended data, so they can see what's happened over time. There's other things that can be added on, to that as well. Things like certain types of monitoring and alerts. So when your FICO went up or down, or a new account was opened. All those things you can get through Bloom by going and pulling the data out. It's all standardized, and then your consumers can ultimately see it. That's actually big for everybody right now. I would say that for credit builder company folks that really are focused on credit builders is also a very important thing, because if you're going to actually open a credit builder product, you obviously need it reported, because that's the only way it's going to build credits if it's reported. But then in addition to that, you also want to show the consumer the impact of that product and what they were able to do from a credit building perspective. So those are very, very important. And more, it's some number, it's something like $10 billion was actually put into like just neobanks within fintech within like the last 4 years or something like that.
Yeah, it's been a big funding cycle.
Big funding cycle. And everyone, I don't want to say everyone, but let's just generalize and say everyone, most of them were operating under the same sort of approach, right? They were basically building a business, getting new customers. Usually they're more kind of subprime-ish customers with less amounts for deposits. But they were just offering them deposit-based products, and they were generating most of their income revenue off of interchange, debit interchange, which is very difficult to do, because also the bigger you get, the more that under Durbin, the amount that you're able to collect on debit interchange drops significantly. I think when you get over like 10 billion or something like that. So there's these unit economics where they got a lot of clients on these deposit products, and it was all debit. And now they're all realizing we need to start actually getting them into credit products and graduating these people into other types of products and services that we can offer them outside of just deposit, where we're earning very little interchange. But in addition to that, the consumer is not really getting a benefit other than maybe having some like overdraft protection that's included or something like that. The last 4 or 5 years before, call it 2017, 2018 to 2021, 2022, was really about debit. We firmly believe that the future is credit, right? Or I don't say the future, now and the future is credit, and how you actually help consumers build and manage their credit and make sure that that data is accurate.
Yeah, and that's where like credit building products become so critical. So this has been an awesome conversation, Christian, and I appreciate all the thoughts and the insights that you've been able to give today. In the final couple minutes here, anything remaining that comes to mind or that you'd like to get across? I think this has been an awesome conversation and covered some really good ground in terms of credit building, what you're building at Bloom, and some of the issues that you guys are addressing. But any final thoughts? I'll throw to you.
I would just say, even just like summing it up, what I think and what we think at Bloom, there has to be a better standard that is actually created and adopted. We feel that we've created it, right, to help the entire credit data industry be better, right, on behalf of consumers. Credit data is broken for a lot of folks, and I think that the very first steps in terms of changing it are making sure that anything that goes in is accurate, right, and that it's not hurting the consumer, and you need to do the validations to make sure and do the work, and I think that's critical. And the other thing is, again, the speed. I think that the era of a 30-day statement cycle, rather, for reporting, it should be dead and should be behind us. And there's a huge opportunity for innovators who are coming in to, I think, go and take market share in this type of environment, where there's been some uncertainty and people are looking at ways that they can kind of create an interesting business in a very interesting time. But we're here focused on this, and again, we want to make sure that the consumers are well taken care of, but we also want to make sure that the major credit bureaus and the lenders also have skin in the game here. And we call it a lose-lose-lose today, the way that the current system is set up, unless there's going to be some additional changes to really kind of right the ship or correct this moving forward.
Yeah, and that's turned that lose-lose-lose into a win-win-win, and it's a positive sum product in my understanding, which is great. Well, Christian, thank you so much for the time today, and we've really appreciated the conversation.
No, me too. Thanks, Greg. Thanks for having me. Appreciate it. Had a good time.